Is now the right time to be buying a GIC? I'm Mark Sabrin from Winnipeg Financial Planning. Let's dig into it. So what exactly is a GIC? A GIC is a term investment that's going to pay you a guaranteed rate of interest on the anniversary of your purchase. So let's say that you have $100,000 and you buy a 1-year GIC that's going to pay you 2%. Well, after that 1 year, you're going to have $102,000. Now, generally speaking, the longer the term of your GIC, the better interest rate that you're going to get. And terms tend to vary anywhere from 30 days to 7 years. Additionally, a GIC can be redeemable or non-redeemable. A redeemable GIC allows you to access your funds at any time, whereas a non-redeemable GIC forces you to wait until the maturity date to access your funds. Now, because redeemable GICs are easier to access, they'll generally pay you a lower interest rate than a non-redeemable GIC. So is now the right time to buy a GIC? So firstly, this implies that there was a bad time to be buying GICs. For the last few years, GIC rates have been extremely low because rates are tied to what's happening in the interest rate market. So if you have a low rate on your mortgage, chances are that rates on GICs are also going to be low. And this intuitively makes sense because banks take in deposits and then lend that money back out to others at a higher rate. So the rate that they pay you on a GIC has to be lower than the rate that you're paying to get a mortgage, or else they won't be making any money. And we all know that financial institutions are in the business of making money. The issue with low GIC rates is after factoring in inflation and taxes, returns tend to be negative. And returns have been anywhere in the range from 1 to 2.5% over the last number of years. Let's say you have $100,000 invested in a 2% GIC. Next year, that GIC is going to be worth $102,000. Now, if you didn't invest that GIC in a registered account, such as an RSP or a TFSA, you're going to have to pay tax on that $2,000 that you made. Now, assuming you're in a 30% tax bracket, that's going to result in a tax bill of $600. So this is going to bring down your net return to $1,400, or in percentage terms, 1.4%. We also need to factor in inflation into the net return. So as we know, the cost of everything tends to go up over time. So 30 years ago, you could buy a jug of milk for $2, and today that same jug of milk costs $5. So let's say that in this example, inflation was running at a rate of 3%. This means that your $100,000 would have to grow to at least $103,000 next year for you to be able to buy the same amount of goods and services. By factoring in inflation of $3,000, your purchasing power has actually dropped to $98,400, or a loss of 1.6%. So to summarize, when you first bought your GIC, you had $100,000, but today it's as if you only have $98,400 because your GIC return did not keep pace with inflation. Today, GIC rates are much higher because interest rates have increased substantially. I took a look at 30 financial institutions, and the best rates that I could find over 1 to 5 years were as follows. As we can see, rates are much higher than they were in previous years, but so is inflation, coming in at an increase of 7.7% in May of 2022. So if you purchase a 1-year GIC for $100,000 at 4%, then next year you're going to have $104,000. Again, if you didn't purchase this GIC in a registered account, such as an RSP or TFSA, you're going to have to pay taxes on that $4,000. Assuming you're in a 30% tax bracket, that would leave you with a tax bill of $1,200, and that would bring your net return down to 2.8%. If inflation comes in at 7.7% for the year, your purchasing power is actually down to $95,100, or a loss of 4.9%. Even though GIC rates have increased substantially, your net return is actually worse today because inflation is so high. Another reason people want to buy GICs is for the stability they provide to a portfolio. If you've been invested in the stock market this year, you'll know that it's been extremely volatile. If we look at the US stock market, for example, it was off its high by as much as 22.5% in June. Should you be selling out of the stock market to buy GICs? Now, historically, the stock market has always risen over time. If we look back at the US stock market since 1990, there have definitely been some blips along the way, but the long-term trend has been for the market to rise over time. So if you believe in the stock market, you should also believe that it's going to recover in time. Let's run through a quick example. Bob had $100,000 invested in the stock market, and after a tough year, he lost 20% and his portfolio was now worth $80,000. He decided he was going to sell out of the stock market and buy a GIC that would pay him 4% per year. With this strategy, it would take Bob 6 years for his portfolio to return to $100,000. Alternatively, Bob could remain invested in the market, and chances are that it would recover much sooner. As we can see, the market can recover quite quickly, in some cases in less than a year. Even during the great financial crisis of 2008 and 2009, it only took the market 3.1 years to recover off its bottom. To summarize, Bob can sell out of his portfolio and buy a 4% GIC, and at that rate, it's going to take him 6 years to get back to $100,000. Alternatively, he can remain invested if he's comfortable with the volatility, and chances are that the recovery will happen much quicker. What if Bob came into some money? Let's say a $500,000 inheritance. Would now be a better time to buy a GIC, as he wouldn't have to sell anything at a loss? If Bob doesn't need this money for a number of years, then he has a real opportunity to buy into the stock market while it's low. As we just saw, the recovery can happen quite quickly. So if Bob is comfortable, again, with volatility, now would actually be a good time to be buying into the US stock market. If Bob plans on accessing this $500,000 over the next 5 years, then GICs are a great option, as you don't want to be invested in the stock market over such a short period of time. If inflation remains high, Bob's net return would likely still be negative, but it's better than just keeping money in a checking or savings account. So is now a good time to buy a GIC? If you have 5+ years until you actually need to use the money, I would say that you have better options available to you. If you need money within 5 years, then I think GICs are great. If you like this video, please subscribe. It helps us out tremendously.